So today's topic is equity valuation concepts and basic tools. Okay. So equity valuation chapter deals with valuation of an equity stock. Okay. So in this, there are certain topics to be discussed. We will discuss right now. First, we will start from here. We are going to start from here. Dividend. We are going to start from the concept of valuation of a stock. Okay. So how to value a stock? I would tell a stock price can be valued in this way. It is nothing but the present value of future cash flows. This particular concept we are going to follow or going to apply for valuing the stock of a company. What is this present value of future cash flows? Of course, when you buy a stock, you expect some dividends from that particular stock. Okay. And at the end, see, there is no maturity period for a stock. Everyone knows, fine. But you would be expecting to hold a stock at least for a year or 2 years or 3 years or 4 years or 5 years. So you suppose have a goal of holding a stock for 5 years. So fifth year will be called as the terminal. The value at the end of the fifth year of the stock will be called as the terminal value. In this way, we find out the intrinsic value of a stock. Intrinsic value of a stock is nothing but your estimated price of a stock. You are estimating the price of a stock based upon certain estimations which you have made. That is some X amount of dividends or estimated amount of dividends you are going to receive in the future for coming some years. And also you are expecting the price of a stock to be some Y amount at the end of its at the end of the time period till which you want to hold the stock. Let's say you want to hold the stock for 5 years. At the end of the fifth year, what the stock value is going to be. You have estimated both, and then you have a required rate of return. That is the return which you want from holding this stock. So you are discounting all those future cash flows with the estimated rate of return what you have estimated, and then you get the present value. Then you get the present value which would be some like Z amount, and that present value which would be some Z amount. So how will you get the present value? You'll take the dividend for the first year and you'll discount with the required rate of return. Then you'll take the dividend for second year. You'll be discounting with required rate of return for the second year. Okay. So it will be 1, then it will be whole square, then D3. And at the end of the third year, you're going to hold the stock also. So we'll speak it as stock at the end of 3 years divided by 1 plus KE the whole cube. So you are discounting in this way and getting the present value. That present value is nothing but the intrinsic value of the stock or value of a stock. Fine. With the help of dividend discount model, we're going to find out. So that stock, once you get the value you get, okay, the intrinsic value of a stock you get, you can decide what should be done, whether the stock is overvalued or undervalued, because intrinsic value of the stock is your estimated value of a stock, and then you see in the market what the price of the stock is going on. Suppose the intrinsic value is $100 and in market the stock is trading at $120. So what you can do, you can buy the stock right now at 100, okay, because the stock is what in market the price is 120 and the price and the stock what you have estimated is $100. Okay. So the stock is overvalued right now. What is that? It is overvalued. So one fine day, definitely it will reach to its exact value or actual value, which as per your estimation should be $100. See, you estimated the price to be $100. Okay, there are very less or rare chances or very like you see rare coincidences where what you estimated and what in the market is going on is the same. So let's say you have estimated $100 and in the market it is $120. Okay, so what you estimated and what the price going on is not same. So then what you can do is you can try to take advantage of the situation, arbitrage opportunity. You can do short selling. How? You can take the stocks, you can borrow the stocks from the people who hold this, sell it immediately, take $120. Okay, wait for the time when the stock comes to $100. Okay, buy the stock for $100 and you can then return the stock from the lenders who have lent this stock to you, or you borrowed the stock, right? So you have to return the stock to the lenders from whom you got this stock. Okay. And in this way, when you sold the stock, you got 120. Out of that, 100 rupees you're using to buy the stock again. So 20 is your profit, what you made from this. Other way around, vice versa. Let's say you have estimated $100 and the stock is right now trading at $80. Okay. So one day it will definitely come till 100. Okay. Fine. It is undervalued. See, when you found out $100, the stock value was 120. It was overvalued. You did the short selling and made the profits. Now you have estimated your price as 100. It is trading at 80. It is undervalued. Okay, it is trading at less price. So now you can buy a lot of stocks, hold it, and wait for the time till it reaches its value, which is 100, and then sell it in the market and make some good profits. Okay, of $20 in this case. Again, you're exploiting the opportunity. So this is the way people take the advantage and exploit the opportunity. Okay, and make good profits. So for making good profit, they should first find out the intrinsic value of a stock. Okay, now as I've given the example here and explained you the way how to find out the value of a stock, we can just use this formula and do the calculation. So here we are taking 1 year holding period. Okay, 1 year holding period dividend discount model, whereby dividend to be received at the end of the first year is called D1. Okay, and year end stock price also we have estimated. All the data is given to you in the question itself. You have and dividend to be received here, you will be finding out in this way. D1 is nothing but D naught into 1 plus G. D naught into 1 plus G is what? Dividend right now at present into 1 plus growth factor will give you dividend at the end of the year. Okay, so right now the dividend is how much? $1. $1 into, it is going to grow at the rate of 5%. So 1.05 is your dividend going to be at the end of the year. So that we are going to take it. $1 divided by our cost of equity is 13.2%. So we will do that right now. So 13.2 divided by 100 is 0.132. 1.05 divided by 1 plus 0.132. Okay, and at the end of the year, the stock is going to be 13.45. So 1.05 divided by 1.132, 0.927 plus 13.45 divided by 1.132, 11.88. You need to add this. It is 12.807. This is the stock value. Okay, this is the present value of future cash flows. Please make a note of this and calculate. We'll go to the next question. Okay, after calculating this, let's move forward. So as discussed right now, we are doing multiple year holding period dividend discount model. We are finding out the dividends for the first, in the sense we have been given the data that dividend is going to be 1.50 as per the question, and it's going to grow at the rate of 8% per year. Okay, for the next 3 years. So 1.50 into 1 plus 0.08, that is 1.08. I'll just write down. Okay. Okay, and then either you can do this thing 1.50 into 1.08 the whole square, 1.50 into 1.08 the whole cube for 3 years, and at the end of the third year the stock value is going to be $51. $51. Okay, and we are going to take this value, this value, this value, and then we are going to discount these values with 12% required rate of return. So 1.62 divided by 1.12, 1.75 divided by 1.12 whole square, 1.89 divided by 1.12 whole cube. See, I'll do the calculation for you. 1.62 divided by 1.12 plus 75 divided by 1. Okay, we can do this in this way also. I'll just write down everything. 1.50 into 1.08 divided by 1.12 discount factor plus 1.50 into 1.08 whole square. Okay. Divide by 1.12 whole square plus 1.50 into 1.08 whole cube divided by 1.12 whole cube, and accordingly I'm going to take the stock price also at the end of the third year. Stock price is going to be 51. If you do the entire calculation, you'll get 40.49. Please do the calculation and tell me. I'm just waiting. Let's move forward. Now, free cash flow to equity. This is the question. This is the concept. For equity holders, what is the free cash flow to equity? So, like for that, you can find out free cash flow to equity with the help of this formula. Cash flow from operations, that is cash flow from operating activities, which you can find out from cash flow statement. From that, they will be utilizing money to do some investment. Okay, capital investment. Okay, and then net borrowing. What is net borrowing? They may get money because of borrowings and there can be some disbursements. So let's say 10 lakhs is what they borrowed and 4 lakhs is what they are making the payments. So the net borrowing here would be 6 lakhs. This is what they can utilize. Okay, and let's say, see, I'll just give you the clarity. Let's say 20 lakhs is cash flow from operations. Out of that, 5 lakhs has been utilized for investments and 6 lakhs is the net borrowing. So 20 minus 5 is what? 15. 15 plus 6, 21. 21 lakhs is what? It is the free cash flow to equity holders. They can utilize this cash for their investments or expansion of the business or whatever they want. Okay. Now, value of a stock can also be found out with the help of free cash flow to equity by cost of equity. This is also one of the ways. So you understand that when we did dividend discount model, we took dividend, right? So restating the general form of dividend discount model in terms of FCFE, that means there we took dividend. Here we are taking free cash flow to equity. So free cash flow to equity, whatever is there, we are going to discount it with the cost of equity and find out the stock value. But they haven't given questions related to this. So we are not doing here. Let us move forward. See, this is the CAPM equation. Okay. Now coming to CAPM equation, hopefully I think you have done the CAPM in your portfolio management, but I will explain the CAPM equation to you right now, the concept right now. Okay. Okay, we were discussing about CAPM equation, right? I'll be explaining in a fresh page. See, let's say we like CAPM is such a model which helps us to understand what should be the required rate of return from a particular security considering all the risk characteristics, okay, or the risks involved in the investments, which are the base for every investor. Okay, in the sense, see, if you want to invest in a particular stock, what crops up in your mind or what thoughts you have in your mind is, if I would have deposited the same money in bank or into any such investment which is risk free, what returns what returns I would have got. Okay, so you are kind of considering various investment options and comparing the investment target which you have selected with those various investments and comparing what your investment target or the company in which you are looking to invest is giving you, and what other investment options are giving you, and then you're trying to find out the answer, what should be the required rate of return from your investment, what you have selected to invest. Okay, so all this, in statements would look somewhat vague, or like, you would be a bit of confused with this, but I would try to simplify this concept. See what happens. Let's say this is a bank and this is a X company. X company is a very risky company. We'll put two horns to this. Okay, this will be, showing that it's a very risky and dangerous company. Bank is giving us 4% returns. X company is giving us 4% returns. Which one you will select? Of course, you'll say yes to bank, and you'll say no to this. You'll say why? For the risk what you are taking of investing in this, you are not getting enough returns. You are not getting satisfactory returns. See, without taking any risk at all, if you deposit your money in bank is giving you 4%, but you are taking very high risk and investing in this company and it is giving you 4%. So given the risk what you are taking here, the returns what you're getting is very less, which, is not satisfactory for you, because if at all without taking any risk I can get 4%, then why will I come to this company and invest where I have very high risk? Okay. Now, secondly, I'll speak about the stock market. Let's say I am holding a index stock, okay, which is a combination of 30 companies, Bombay Stock Exchange I'm speaking about. Stock market is giving me 7%. Again, this X company, which is a risky company, is giving me 7%. I will say yes to this and I'll say no to this and tell go to hell. But why? Because I'm taking very high risk and I'm getting 7% here. I'm taking a very calculated risk because this is a very diversified kind of investment which I've done, and I'm getting very satisfactory 7% for the risk I'm taking. Here for the risk what I'm taking, I'm getting less returns. So I'm not satisfied with this. I will never go for this. Okay. So my question to you is now, how much returns you should be expecting from this particular investment? So the question to so the answer to such question is, with the lies with the CAPM equation. CAPM equation will give the answer to your question, how much returns you should be expecting from X company, which is a very risky company. Okay, so let's calculate that. Expected return from a portfolio, risk-free rate plus beta into market returns, or expected return from market minus risk-free rate. So we'll put all the things here. Risk-free rate in our context was the bank's returns, or bank which was giving us 4%. Only thing is you don't know what is beta. I'll explain you. Expected return from market is 0.07. Risk-free rate is 0.04. Only the thing is beta. See, beta is an indicator of risk, but only systematic risk. See, what they say is what what risk you have as an investor is only the systematic risk, because now what is systematic risk? Systematic risk is risk of the system. Okay, there is some A company which is a single company, and there is a well diversified, just a second. And there is a index stock here, BSE index stock. Okay, now what happens if you invest in only a company? Okay, there can be a chance that this company can go into losses. Now it can go into losses due to many reasons. The macroeconomic reason can be market crash, GDP is falling, etc. Microeconomic reasons can be some fraud has happened in the company. Okay, some money laundering, some employee fraud, or some XYZ events have happened, some scam has happened which has made the company to go into deep losses. So if that is the case, then what happens is you can like apply your sense, you can apply your wisdom, prudence. What I mean by this? Don't put all eggs in one basket. See, if you put all the eggs in one basket, the basket falls, all the eggs will damage. Better you take two baskets to a market to buy eggs. If you put half dozen eggs in this and half dozen eggs in this, if this falls, still you have half dozen eggs in this basket which you can utilize. Okay. So what I mean to say here is, if you want to invest your money and take a very calculated risk, go for diversification or go for a portfolio form of investment. With diversification, your risk would be minimized if you are a rational investor. Okay. If you're a risk seeker, want to take very high risk, then this is still a good option for you. So this particular risk is called as the risk of investing in a one single company stock is called as unsystematic risk, which you can definitely minimize through diversification. In portfolio management, you've already learned. Okay. And you're not spending any money or any, extra cost for minimizing your risk. You're applying just your judgment. You're being wise and doing this. Just a second. So if you put your money in BSE index stock, what is happening? Yeah, unsystematic risk can be minimized through diversification. That means you can make a portfolio of A company along with some B company and C company. So what happens if A company goes into losses and B and C, so A company has gone into 5% losses, B and C company has combined returns of 18%. So 18 minus 5 net in net, you have 13% returns. An example to just simplify the concept. So this can only be possible through diversification. If you would have only invested in a company and if it would have gone into losses, you would have lost the entire money. So that is what the portfolio form of investment is all about. BSE index stock is already a portfolio kind of investment, whereby 30 companies are the participants of Bombay Stock Exchange, and whatever the money you're investing is going into each and every stock. Okay. The money is getting divided and going into each and every stock. The investment is happening in every stock. Okay. And then you're getting an average return out of it. Fine. So now see, here you can diversify, but here you can't diversify because already there are no more participants than 30 companies. So when the market will crash, every stock has to suffer. When a company goes into losses, market is not going to get affected. Adani's stock, I should not be using the names, but recently there were reports, right? The stocks went down because of some Hindenburg report, but that did not impact the market in a bigger way. The market was still stable because it had all 29 companies doing well. So what happens is, if there is one company which is going into losses, doesn't have bigger impact on the market, it can have a small impact. But if the market would crash, every single company would suffer. So here I would say this particular risk, what you have here in case of BSE index stock, that market will fall, every stock will suffer, is called systematic risk. That is the risk of the system. If the system will crash, everything will crash. And this cannot be minimized through diversification. So this is the final risk and it is indicated by beta. Okay, and beta is equal to 1 is the risk of the market. That means this is the 100% risk. If at all beta is more than 1, that means the investment in which you are putting your money is more riskier than market. For example, beta is equal to 1.2 is like TCS company's beta. We can get this information from the market, stock market. So TCS company is 20% more riskier than market. Beta itself means risk of investing in a security, which is TCS, divided by risk of investing in stock market. So which is very clear. TCS risk is 1.2 and stock market risk is 1. So beta automatically will be 1.2. It is 20% more riskier than market. Okay. So now I will again come to my old CAPM equation after explaining you the details about beta factor. Let us take the beta for X company, which is a risky company, to be 1.6. As the beta increases, the risk increases. As the risk increases, the expected return should also increase. Okay, so let's do the calculation here. So 8.8% is your expected return from this X company, which is very risky company. Okay, make a note of this. I'm just waiting fast. Okay, now you can do the calculation of one of the questions. I'll give you CAPM equation to calculate. Okay, so now the reason for finding out the CAPM was to find out the expected return from a stock. Okay, the expected return for a stock from a stock for the investor is the cost for the company. Okay, see your the return for the investors is cost for the company. Fine. So we will generally be finding out the cost of equity with the help of CAPM equation, which is either way also looked at as expected return from a stock. From the investor's perspective, it is expected return. From the company's perspective, it is cost. Okay. And this particular cost of equity is again used as discount factor for discounting the future cash flows. So we are done with equity. Now we are going for the preferred stock. So preferred stock is also the same concept. We are finding out the cost of preferred stock. Intrinsic value of a non-callable, that means the ones which company cannot buy at a agreed price. Okay. And non-convertible, which cannot be converted into equity. And intrinsic value is nothing but estimated value of a stock, which is based upon your estimate of the dividends and the cost of preferred stock, or the returns what investor wants from a preferred stock, which can be used as a discount factor. So you can take up the dividend and you can discount it with its cost of preferred stock. You'll get the stock value. Okay, so dividend is $5 and the KP is 8%, so it is 62.50. We'll move forward. Now we are going into the Gordon growth model. Okay, constant growth model, that is dividend is growing at a constant growth rate, which we have already applied. Okay, this particular formula, which is summation, is again simplified in this way. When the growth rate of dividends is constant, this equation simplifies to Gordon constant growth model. That means D naught into 1 plus G. This is the first year dividend or the next dividend. If you want to find out the next dividend, it can be the present dividend into 1 plus growth factor divided by the cost of equity minus growth factor. We are adjusting the constant growth in the denominator. See, why are we subtracting or adjusting the constant growth in the denominator from the cost of equity? Let's say the dividend I am taking $10 and the growth rate is 5% and my cost of equity is 15%. My growth factor is 5%. I'm subtracting growth factor from my cost of equity. See, in numerator, I'm showing that my dividend is growing, and in denominator, if I discount the numerator value with a higher discount factor, whatever growth I am showing is again, not getting reflected, because a higher discount rate in the denominator is eating away the growth what I'm showing in the numerator. So now as I have to show the growth in my numerator value, I'm adjusting the denominator cost of equity with dividend growth. Okay, so I'm removing the growth factor, as already I am kind of showing a higher growth in the numerator. This I will be subtracting from the cost of equity so that my discount factor will reduce and less discounting will happen and the growth can be seen. See, that much detail is not required for you. People only remember the formula, but I'm giving you the justification. So let's do a question here and finish this. So there is a dividend which is 1.50 last year, and it is going to grow at the rate of 8%. So 1.50 into 1.08 is going to give you 1.62, and that again we are going to discount with 12%, and also we are going to adjust the growth factor. So we are going to get 40.50 as stock value. Okay, please go to this question. Now, next question. They are asking you amount of estimated stock value due to dividend growth. See, using the data from the previous example, calculate how much of the estimated stock value is due to dividend growth. See, Dividend is 1.50. Cost of equity is how much? 0.12. So the stock value is 12.50. And previously, the stock value which you have found out, see, was 40.50. Okay. So what is the difference created? See, if there was a growth rate of 8%, something around 8%, right? In the previous example, yeah, your stock value was 40.50. It grew, okay? And without any growth factor, your stock value is 12.50. So because of growth factor, 40.50, without growth, 12.5. So there is an increment of or difference of $28. Fine. Now, next one. Now we will try to find out the growth rate in dividend. See, sustainable growth is what? Let's say your company in which you own a stock or you own some stocks is giving you 100, is earning a profit of $100. Okay. From that $100, you are paying a dividend of $20. Leftover is $80. You are investing this at the rate of 10%. So what is your sustainable growth rate? 8%. That is what they have given the example with. So what they are doing, 1 minus dividend payout ratio. See, I told you we are earning a profit of $100, paying a dividend of $20. So 1 minus dividend payout ratio, 1 minus 0.20 is 80%. So I'm taking in dollar value to make the thing simple. And I'm, 0.08 into, I'm investing it at 10%. So my growth rate is 8%. Okay. So please find out this one. You can see 1 minus dividend payout ratio. Okay, 100 minus 25, 75. Investing at the rate of 21%, return on equity is going to give you a growth rate of 15.75%. That means this is the growth rate. Nothing but after making the dividend payment, the leftover profit which you have retained, you are going to reinvest, right, at some rate of return, which is nothing but return on equity at 21% is going to give you a growth of 15.75. Please make a note of this. We'll move forward. So we will continue from here, a firm with no current dividend in tomorrow's session, or else no problem. We'll do this question and stop. So a firm currently pays no dividend at all, but is expected to pay a dividend at the end of year 4. Year 4 earnings are expected to be 1.64 and the firm will maintain a dividend payout ratio of 50%. So we will first go at the end of year 4. At the end of the year 4, the dividend amount has not been given, but we can find out that dividend amount. What we'll do, we will take the dividend payout ratio 1 minus 0.50. So 0.50 is retained and earnings of the year 4 is 1.64. So 1.64 is the earnings of that 50%. See, 1.64 is the earnings. 50% is paid as dividends. So 50% is retained, which has to be reinvested. Understood? So retained amount is this. Okay. 0.82 is the retained amount. 0.82 is the dividend amount. See, 1.64 is our, earnings, right? 50% goes for dividend payment, 50% goes for retention. 0.82 goes for retention, 0.82 goes for dividend payment. So we got the dividend of the fourth year. Okay. Now we can find out the stock value at the end of the year 3 by taking the future value of the dividend in the future value of the dividend which is in the year 4 as 0.82. So fourth year's ending dividend value is nothing but the future value. We will take that future value and we will discount with cost of equity by adjusting growth rate to get the stock value at the end of year 3. Okay. Now, at the end of year 3, the stock value is 16.40. We'll bring it to the present scenario. And what is the discount factor given to us? 10%. So 1.10 whole cube. So we will get the stock value as on today as 12.32. Okay. So what they did is first they took 1.62 earnings. They did 50% of this to find out the dividend value. They got 0.82. That is the dividend value at the end of the year 4. That they took the cost of equity to discount and growth factor they adjusted so that they get the value of the stock at the end of the year 3. End of the year 3 stock they discounted back to present value 1.10 whole cube because 3 years, right? This is the end of the year 3. So we discount it back to 3 years as on today. So it will be 12.32. So the value of the stock as on today is 12.32. This is the final question of the day. Tomorrow we will be going with multi-stage dividend growth models, whereby you will be seeing that dividend is growing at the rate of some X% for some few years, and after that it is going to grow at Y%. And then how are we going to find out the stock value in such cases? Fine. Thank you.